So welcome back to another webinar organized by Princeton University's PCF. We're very happy to have Bill Dudley with us today. Hi, Bill.
Hi.
Bill is currently at Princeton, but he was the president of the New York Fed before, and he handled a lot of the financial crisis, the previous financial crisis, so he can give us a lot of details and a lot of experience from his previous work. And I should say he started out working for the Federal Reserve Board and then went to Goldman Sachs and then became Fed president of the New York Fed. But today he will talk about the longer challenges for the Federal Reserve Board and monetary policy more generally. Before we go to Bill, let me go back as usual. What we do on Friday? Geeta Gopinath was talking about the great global lockdown. Very interesting to watch her insights and the statistics she presented. And on Friday, Daryl Duffy will present how to fix the repo market or how to reinvent the repo market, and he has very particular proposals for that. As usual, you know, we have it every Monday, every Friday, 12:30 New York time. We have our seminars. There are a lot of speakers coming up. Here you see a picture of all the speakers, and we hope that you will all join us and be part of this endeavor. Today, I would like to give my opening remarks a little bit also about central banking, some few perspectives and the big picture perspectives, and then we pass back on to Bill Dudley. So let me start with a picture I would like to give. It's what I call the big inflation whipsaw. There might be a trend reversal. We might have first deflation pressures or very low inflation, and later on we might have inflationary pressures. I've written a paper with Sebastian Merkel, Jonathan Payne, and Yuli Sannikov, trying to isolate various inflation and deflation pressures. You know, initially now we have essentially, it's very hard to consume, so there's some forced savings. That actually reduces inflation pressure. It's a more deflationary pressure. There's increased risk. People save more, precautionary savings, will lead to more savings, less spending. That's also deflationary. But there are also underlying capital misallocations, leads to less productivity. That leads to inflationary pressure. We also show that, you know, if the government redistributes a lot, that leads to inflationary pressure. So if the government helps out a lot and redistributes from people who are not so much hit by the corona crisis to people who are more hit, then actually deflation will be lower or inflation will be higher. Of course, what you believe the government will do down the road matters a lot. How much pent-up demand will come up later on. The lending policy, how much the government will help out in the lending policy matters. Whether large firms will become less competitive because small firms are dropping off the market and hence they will charge higher margins. That's an inflationary pressure. And also, you know, how will the financial sector evolve in this crisis? So what we see essentially is this, what I introduced here today, the first time, this inflation whipsaw, going down, first deflationary pressure, then inflationary pressure, and how to manage that. And what I think is very important for any central banker is to avoid traps. So what I've depicted here, if you look up there, so I've depicted a little fish going into a trap, and then you're stuck in it. And that's what central bankers should try to avoid. There's a lot of temptation to do this or that and help out, but then at the end you might be trapped and don't get out of it. And you might have a whole pathway full of traps, and that's essentially what central bankers have to look out for, watch out for, and avoid. And that's what we will talk about today as well. The next thing I would like to highlight is what's the similarity between a race car and a central banker. So what do both have in common or should have in common? And what a race car has, that's actually an electric race car, is to have an accelerator and brakes. And central banks need both. They have to, if there's deflationary pressure, you have to be able to accelerate. But what's equally important is to have the brakes. If you have good brakes, you can accelerate better, can be more aggressive. And that's why you will have the accelerator. You can make more use of the accelerator if you have good brakes. And what are the two brakes? So one is the central bank independence, in order to avoid fiscal dominance, that actually the fiscal authorities, the government is actually determining the inflation on the fiscal side. And the second thing is avoid financial dominance, where the financial sector is dominating because it threatens instability. what the central bank has to do. And for this, you need prudential regulation, microprudential and macroprudential regulation. So the breaks, the two key breaks are central bank independence and prudential regulation. Now, let me go to this interplay between the fiscal authority and the monetary authority, the central bank, and they often play a game of chicken. You know, these two cars running towards, driving to each other, and then the question is who is swiveling first, and that's the loser, and the other one can get through. That's a game of chicken, which is well analyzed in game theory, and that's essentially what these two authorities play. And the fiscal dominance, if the fiscal dominance regime is prevalent, then it is actually the case that the fiscal authorities just do what they want to do. They spend, they don't bring their expenditures to GDP ratio back down. And then the monetary authority is not so powerful. It can't really raise the interest rates, because if it raises the interest rates and the fiscal authority is not reacting to it, it doesn't really help to bring the inflation down. In contrast, if you have monetary dominance, then the central bank is in the driver's seat and is dominating the scene. Then the fiscal authority, when the interest rate is hiked up by the monetary authority, the fiscal authority has to adjust its budgets, has more interest rate expenditures, and has to cut back on other expenditures. These are the two regimes. Nothing is black and white. They're playing a game. They play a game of chicken. And that's essentially very important to understand how this will play out in the future, given our current circumstances. Now, the game of chicken becomes more complicated if you have the financial sector on it as well. And that's essentially where the financial dominance comes in. So the financial dominance means, that's what I've introduced in some BAFI lecture in the Bank of Italy. You can download it from my website, where the inability or the unwillingness of the financial sector to absorb some losses, because the financial sector is not raising new equity or is even paying out dividends before in the early phase of the crisis. That makes the financial sector very vulnerable to a financial crisis. And because of that, it forces essentially the fiscal or the monetary authority to intervene. It could be the fiscal authority trying to recapitalize the financial sector, it's very unpopular, or the monetary authority, the central bank, to recapitalize indirectly by changing certain asset prices to recapitalize the financial sector. So you have this financial dominance playing into this game as well, where the fiscal authority and the monetary authority might be forced to do something, and then they're playing another second game of chicken, depending who has to do the bad thing, which unpopular measures, either fiscal recapitalization of the banks or the monetary authority intervening, helping out the banks. So that's some quick overview. Let me now go into the poll. I would like to ask today, the poll is essentially the big inflation whipsaw. Is it unlikely? Or do you think it can be controlled by central banks? So even if the forces, the pressures come, the inflationary pressures are coming, will it be controlled by the central bank pretty well? Or do you think it's a likely outcome that we have actually first a decline in inflation, then an increase? The second question I would like to raise to the audience is, do you think central bank independence is still very important? Or it's less important now that we actually need more cooperation between the fiscal and monetary authority? And you know, this is mostly where the inflation was too high. We needed central bank independence. While, you know, recently, the last decades, we had too low inflation. We couldn't get the inflation up. And the third question I would like to raise in the poll is, if you play a game of chicken, who will win? The fiscal authorities or the monetary authorities, the central banks? And finally, do you think financial dominance is highly relevant, even in the current circumstances? Or do you think it's less relevant for the COVID crisis? Because the COVID crisis is very different from the last financial crisis. Now the shock is coming from outside. It comes essentially from the non-financial sector. It's a health shock. And the financial sector seems to be very well capitalized. And that's essentially would like to get your ideas about that. So perhaps you can give us your perspective, and then I will summarize it. Okay, so the big inflation whipsaw is unlikely, is at 34% say, and can be controlled by central banks, 38% say, and most likely outcome 33%. So it's actually almost a third split between all. So, but 2/3 think, you know, either it's unlikely or central banks will manage it pretty well. That's to some extent comforting. And central banks independence is still important. 70% think it's still important, and 32% think that it's less important. You can actually pick both, so that's why it adds up to more than 100%. But it's only probably one guy picked two. The game of chicken will be won by the fiscal authority or the monetary authority. 2/3 or 64% think it's actually won by the fiscal authorities and not by the monetary authorities. And the financial dominance is highly relevant. 58% think. Less relevant for the COVID crisis. 43% think that's less relevant. Okay. So with this, I will pass it on to Bill. Let me just switch briefly.
Okay, well, that was a great introduction, Markus. Next week, the FOMC meets, and there's a lot of attention being paid to what's going to come next from the Fed. They've been very busy over the last few months in terms of easing monetary policy and introducing a tremendous number of different facilities to support market function. And I would say in the short term, things are going relatively well. I mean, the Fed has been viewed as aggressive and successful in making financial conditions more accommodative and in restoring market function. But rather than focus on what the Fed's going to decide next week, I thought I would take a longer term perspective today about the Fed. And I'm going to discuss 4 challenges that really parallel a lot of what Markus covered in his introduction. So we go to the next slide, please. So the 4 things I want to talk about are number 1, the risk surrounding the Federal Reserve's balance sheet. The Fed's balance sheet has exploded in size. And the question is that completely benign, or are there actually risk embedded in the Fed having such a large balance sheet? The second issue is one that we covered in our polling results. The Fed and Treasury are working together very, very closely right now. Is that something that's a feature, or is that a bug? And what are the long-term consequences of this close interaction between the Fed and Treasury for the Fed's independence? Third, I'm going to give my thoughts on inflation and deflation. What's the greater risk? And then fourth, I covered the issue of fiscal financial dominance. We've seen some pretty significant interventions from the Fed that have essentially bailed out some people who had bad positions in financial markets. And the question is, how concerned should we be about that and encouraging bad behavior in the future? And if we are concerned about it, should we address it? So let me turn first to the issue of the Fed's balance sheet on the next slide. So the Fed's balance sheet has basically nearly doubled in size just in 3 months. So we're now at a balance sheet of over $7 trillion. It's growing very, very rapidly, much faster than it rose during the great financial crisis. And the increase in the Fed's assets have really been driven by three sources. First, a big increase in Treasury securities holdings. The Fed has increased its holdings of Treasury securities by $1.7 trillion over the last few months. Second, it's been buying a lot of mortgage-backed securities, agency mortgage-backed securities. That's gone up by $500 billion. And the foreign currency swap programs have added almost another additional $500 billion. So it's increased by roughly $3 trillion, and 90% of that is due to Treasuries, agency MBS, and foreign currency swaps. So despite all the attention to all the other programs, they're actually pretty modest in terms of what the consequences are for the Fed. It's likely that this balance sheet growth is going to continue in the future as the Fed's special liquidity programs start to open up. This week, for example, the Fed's going to start its Main Street lending program. And the Fed's continuing to purchase Treasury and agency mortgage-backed securities at a pretty rapid rate. The current purchase rate is nearly $100 billion per month for Treasuries and nearly $100 billion a month for agency MBS. So I would guess that by the end of the year, we're probably looking at a Fed balance sheet that's on the order of $9 to $10 trillion in assets. That compares to the great financial crisis where we peaked at around $4.5 trillion. Now, for every dollar of asset that's added to the Fed's balance sheet, there's also a liability. Things have to balance. And what we see in terms of the liability side is a very rapid increase in the amount of bank reserves, which now have climbed to 3.3 trillion. So that's basically doubled in the last few months. Another area where liabilities have increased quite sharply is the U.S. Treasury. Cash balance at the Fed is currently $1.3 trillion. The Treasury has raised a lot of money, a lot of cash, and that cash is sitting at the Federal Reserve. As the balance sheet continues to grow, and probably the Treasury's cash balance at the Fed comes down as they start to spend that money, I would guess that by the end of the year, we're probably going to see something like $2 trillion of currency outstanding and 6 to 7 trillion of excess reserves in the banking system. So you can think of the balance sheet is going to be a small portion of currency and a relatively big portion of excess reserves. So what are the implications of this? Well, the first implication of this is that the Fed is really locked into their current monetary policy framework. If you look at what the Fed's framework was before the great financial crisis, the Fed had a relatively small balance sheet, about $800 billion, and had very few reserves in the banking system. The Fed would intervene on a day-to-day, week-to-week basis to add just the right amount of reserves to the banking system designed to keep the federal funds rate at the target. So the quantity of reserves was the driver of the federal funds rate. Post the great financial crisis, the Fed moved to a floor system where the amount of reserves is not what drives the federal funds rate, it's the rate that the Fed pays on reserves to banks, the interest on excess reserves, or IOER. The Fed has said that they're comfortable with this new regime, but they don't have a choice at this point. They're going to be stuck with a regime where excess reserves are going to be in trillions of dollars for many, many years. So it's a good thing that the Federal Reserve is comfortable with this regime. What's interesting about it, though, is while the Fed is comfortable, a lot of other people are not. There's a general perception that this, among some people, that this is a bad thing because the Fed is basically paying banks interest not to lend out their reserves. And so sometimes people talk about the Fed's current operating regime as not a good one because banks are getting rewarded to not lend as opposed to lend. But this is the regime that we're going to be in for quite a while, and the Fed Reserve needs to do a better job explaining this. Now, in terms of thinking about the balance sheet risk, there's two kinds of risk on the Fed's balance sheet. The first is credit risk. What's the chances that some of the assets that the Fed holds don't perform and the Fed takes losses? And the other kind of risk is interest rate risk. Now, if you look at the composition of the assets, you can see that the credit risk that the Fed Reserve is taking is really, really low. The main assets are treasuries, agency mortgage-backed securities, which are essentially backstopped by the US government, and foreign exchange swaps to foreign central banks. That's 90% of the assets. The rest of the assets are other things, and some of them are these special lending programs that are just getting started today, this week. But those are also backstopped by the Treasury because the Treasury is providing the first loss piece. So while it's conceivable that the Fed Reserve could lose money on some of these special facilities, it's actually quite unlikely because the Treasury has provided a pretty big buffer before the Fed suffers losses. So my own personal view is that the risk of the Fed from the credit side on its balance sheet is really de minimis. So what is the biggest risk? Well, interesting enough, the biggest risk the Fed has on its balance sheet is actually interest rate risk. Because while it holds a lot of longer dated assets, treasuries and agency mortgage-backed securities, most of these assets are funded by bank reserves, which are an overnight liability. Now, currently it's not a problem because the Fed is basically paying 10 basis points on interest on excess reserves, nothing on the currency outstanding. And the average asset in the Fed's portfolio is probably generating a yield for the Fed of about 2%. So the Fed Reserve is actually making a pretty big profit in terms of the current operating earnings of the Fed. But imagine a situation down the road where the Federal Reserve has to actually raise interest rates significantly. Well, if that were to happen, the Fed would suffer the same problem that we saw in savings and loans in the United States in the 1980s. The yield on the Fed's portfolio would adjust only very slowly because the duration of the portfolio is pretty long. So if short-term interest rates were to rise significantly, you could conceivably get into a situation where the earnings that the Fed had on its assets were actually less than the interest that it was paying out on excess reserves. The Federal Reserve could actually lose money. And the level of short-term rates that would cause that result are really not that high. It's probably on the order of about 3.5% short-term rates. remembering that the Fed doesn't have to pay interest on currencies, it's just the interest on reserves. So it can actually calculate how high would short rates have to be before the Federal Reserve actually loses money. Not that high. Now, I don't think this is a disaster. There's no requirement that the central bank has to make money. But I would expect if all of a sudden the Fed is losing money, people will start to understand that the balance sheet actually does have some risk. And that could have a political consequences to using the balance sheet aggressively in the future.
So I can ask a quick question.
Sure.
Is it the case that the Fed can easily change again, going away from the floor system and going back to the old system, or that's?
Well, they would basically have to shrink their balance sheet back down or engage in a large quantity of reverse repo activities to drain reserves from the banking system to get reserves down from, what are probably going to be $6 to $7 trillion of reserves at the end of this year. They'd have to get them down close to zero. So that would be a huge operation to try to shrink the balance sheet by that magnitude. So I think, while theoretically they could do it, practically, I think the chances of that happening are nil. The Fed is basically taking interest rate risk in its portfolio today. And, if there's an economic recovery, the Fed will probably say, look, it was worth it. If the earnings on our assets turn out to be less than the interest rate we pay on the reserves because the economy recovered strongly, that's not a bad thing. If conversely, the earnings on our assets are less than the interest paid on reserves because we have a big inflation problem, that I think would be quite a bit less appealing.
What about if the new regulation says the reserve requirements go up dramatically and only the excess reserves get the interest payment?
Well, the other problem that the Fed has with the increase in its balance sheet is that increases the amount of reserves in the banking system, which is the last big implication of the Fed's balance sheet. As the Fed increases its balance sheet, the amount of reserves in the banking system go up. That expands the banking system's balance sheet itself, which actually makes the bank, the leverage ratio, the capital requirement leverage ratio more binding. So the Federal Reserve is actually, working a little bit at cross purposes when it blows up its balance sheet, because it actually makes the leverage ratio more binding for banks. And that's why we saw earlier this year that the Federal Reserve temporarily relaxed the leverage ratio requirement and basically said, we still have a leverage ratio requirement, but we're going to exempt from the leverage ratio requirement. It's not going to be total assets. It's not going to be capital over total assets. It's going to be capital over total assets, not including reserves and not including treasuries. So the Federal Reserve is basically saying all the reserves that we're adding to the banking system, you don't have to count that in your leverage ratio. I think we're going to find that this particular adjustment is going to be pretty long lasting, because if the amount of reserves in the banking system stay high for a very long time, the Federal Reserve is not going to want to make that leverage ratio come back and become very, 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 very binding. We can move on to the next slide. The second thing I wanted to talk about was the issue of Fed Reserve independence. As you know, the Fed is working very, very closely right now with United States Treasury, and I've gotten this question a lot. Is this compromising the Fed's independence? Well, my personal view is that at the current juncture, it's not, because there's really no conflict between what the Treasury wants, what the Congress wants, and what the Fed wants. They all want to support the economy to the maximum extent possible to try to generate the strongest recovery possible following this pandemic. So the fact that there's no political debate, there's no disagreement across the Democrats and Republican parties means that the Fed has full support right now of Congress in what they're doing. I think the reason why there's no discord right now is because everybody agrees that the economy needs a lot of support. But that said, the Fed is, I also think this notion of Fed independence is a bit overstated because the Fed, its independence it's a choice. It's a political choice that Congress makes. Congress basically sets the objectives for the Fed, and the Fed carries them out. The independence of monetary policy is really a decision about how do you conduct monetary policy to best achieve the Fed's objectives. Congress doesn't tend to intervene on that on a day-to-day basis. But if the Fed were to, pursue those objectives in a way that Congress made the Congress very unhappy, Congress could always intervene and change those objectives. So I think when we talk about the Fed's independence, it's not that the Fed can do whatever they want. I think we have to define the notion of the Fed's independence much more narrowly. It's really about how to achieve the objectives of full employment and price stability, not beyond that. Now, the current regime, as I said, I don't think this is really undermining the Fed's independence, but you could certainly imagine longer term that there could be a conflict when the Federal Reserve, actually wants to begin to remove accommodation. There could become a point where the Federal Reserve wants to raise interest rates, and the U.S. administration and the U.S. Congress doesn't. And that's, I think, when the question of independence could become a lot more meaningful. One key point where that potential stress could become very significant is something that Markus talked at the beginning, is we've actually seeing a very significant deterioration right now in the U.S. long-term fiscal outlook. This year, the budget deficit is probably going to be on the order of 3 to 4 trillion. That's 15 to 20% of GDP. As a consequence of that, the debt to GDP ratio is rising very sharply. It's not a problem today because interest rates are really low and debt service costs are still very contained. But one could certainly imagine a situation down the road where when the Fed starts to raise short-term interest rates, debt service costs start to go up significantly, and that intensifies the squeeze on the fiscal side. Will the Fed at that point be able to retain the independence of monetary policy? The Fed is able to continue to be independent on monetary policy. The Fed will raise rates. That will increase debt service costs. That'll make the fiscal problems more significant. If not, the Fed will be forced to monetize the debt. And of course, the consequence of that will be higher inflation. So the issue, I think, of independence down the road is quite significant. And I think the main source of that risk is really the fiscal situation, which is deteriorate very sharply and is likely to continue to be under strain, especially when interest rates begin to normalize. We turn next to the next slide, please.
Can I ask one thing to the independence?
Sure.
How do you view the recent attempts of federal Fed chairmen to communicate with the public directly, rather than just to press conferences, but also being on TV shows and so forth? Do you think this will create a bigger tie between the public and the central bank, the Fed, and hence grants a little bit more independence defense?
I think it's helpful for the Fed to be more transparent for a couple of reasons. One, it explains what the Fed then can explain is a little bit about what it's trying to do and what it's trying to accomplish. And so I think that's helpful. But it's also helpful to be transparent so that people can understand what's likely to happen as the economic situation changes, so people can anticipate future Fed actions. So I think it's a good idea for the Fed to try to demystify itself. But I think it's hard. I think it's challenging. I mean, the central bank is pretty opaque to most people. And so I think even if the Fed tries to explain its actions, I think that can be challenging at times. One particular challenge I think the Fed has is to explain what it can do and what it can't actually accomplish. Monetary policy is not all powerful. It cannot restore income. It cannot necessarily create jobs. It can basically make the markets function well, can basically make the interest rate environment benign. But beyond that, monetary policy is quite limited. And so I think that one of the biggest challenges for the Fed is that people think that the Fed can do more than what it actually can accomplish. So let's turn to the third issue. Yeah, go ahead.
So about some other independence issue, which is about the special purpose vehicles of many of these programs where the Treasury takes the first loss tranche, essentially. The governance of these SPVs, special purpose vehicles, how is it designed in a sense, and is it also a problem for independence? It seems to me that the Fed has pretty much control over these SPVs, and it might be shifting, the control might be shifting, or there might be some battle for control over these SPVs at some point. Do you see problems down the road on this dimension?
Well, I think, historically, at least, the Treasury has deferred to the Fed and let the Fed run the special facilities. But you can certainly imagine a situation where there might be a bit of tension between how much risk the Treasury wants to take in a particular facility versus how much risk the Federal Reserve wants to take. I mean, the Federal Reserve wants to make sure that the Treasury's first loss piece is sufficient to protect itself. And the Treasury might not take, that same view. The Treasury might say, hey, this money was allocated from Congress, and we should be using it to support economic activity. So there may be a time where the Federal Reserve could be potentially more conservative than the U.S. Treasury. But so far, I think the Treasury has pretty much deferred to the Fed and let the Federal Reserve define the terms and conditions of the different liquidity facilities. So far, I don't see any conflict between the Treasury and the Fed on this.
Thanks.
So the third issue I want to talk about is something that Markus also raised at the beginning, the issue of inflation whiplash is how Markus put it. And the question is really, what's the greatest risk? Well, I think in the short run, I think we can all agree that the near-term outlook is deflationary. We're seeing a very large spike in unemployment, and we'll see sort of how large on Friday when we get the employment report for May. We've seen a substantial increase in excess capacity. We've seen substantial declines in commodity prices. All those things are clearly deflationary, and we can see them in the data. The overall personal consumption expenditure deflator for April showed a 0.5% decline. The core PCE deflator showed a 0.4% decline. Just over the last 2 months, the year-over-year change in PCE deflation has gone from 1.8% year-over-year 2 months ago to 0.5% now. And core PCE deflation has gone from 1.7% year-over-year 2 months ago to 1% right now. We may not be quite done yet with the deflationary pressures. So there's no question in the short term that the cyclical outlook is pushing inflation lower. And I think that's likely to dominate for some time. Because even if we get an economic recovery in the second half of the year, most people think it's not going to be a V-shaped recovery, that the unemployment rate is going to stay elevated for quite some time. And that means we're probably still going to see further downward pressure on inflation. I think though, as we get past the next year or two, I think the long-term secular outlook, I think there's pretty strong case for the long-term outlook being potentially quite inflationary. First of all, we're seeing a lot of disruptions to supply chains, realignments of supply chains, and we have to recognize that as people adjust how they produce their goods and services, this is going to introduce frictions, which is going to reduce productivity and result in higher costs. Second, the basket of goods and services that people want is probably going to change as a result of the pandemic. And that's going to require the reallocation of capital and labor, and that's also going to increase frictions and drive up costs. Third, there's a pullback from globalization. And so if we do become less globalized as an economy, we're going to lose some of the productivity gains that we've gotten from global specialization. And then finally, the fiscal position, the fact that the fiscal position has deteriorated so sharply means that there's going to be quite a bit of pressure on the Fed to allow more inflation to devalue the burden of that higher government debt on future generations. So I think that, in the medium to longer term, the risk of higher inflation, just like after World War II, is actually quite high. This is not a concern in markets today. If you look at the Eurodollar futures market, Eurodollar future prices imply a yield of 1% or less 6 years from now. So the market basically has a view that rates are going to stay low almost indefinitely in the future. But I think that, looking 3, 4, 5 years out, I think there is more risk of a snapback in inflation than the markets got priced in at this point.
What do you mean by quiet? Can you quantify that? And
Pardon
the
me?
other aspect, quite inflationary. And the other thing I would like to ask the
Well, it's a choice.
Pardon me? Sorry.
How much inflation you get? I mean, it'll be a choice of the Fed and the political process, right? The Fed will probably try to resist higher inflation, and the question is, will that cause Congress and the administration to rein in the Fed and rein in monetary policy independence? We saw after World War II that there was first a period of financial repression, and then the Fed Treasury Accord came to an end in the early 1950s. And it took a long time for the inflation to bubble up, but eventually, a good chunk of the burden that was taken on during World War II was basically inflated away in the 60s, 70s, and the first part of the 1980s. So there's going to be a lot of pressure to allow faster nominal GDP growth. And the way you allow faster nominal GDP growth is you allow higher inflation.
How do you see the Bank of England or the UK government in particular is talking about debt monetization? How do you see this playing out in the US, or how do you value, the language which comes out of the UK? Do you think that's part of the solution of getting rid of the high fiscal debt level again?
Well, I think at the end of the day, you can't really, you can't monetize the debt in the long term without inflation. You can monetize the debt in the short term as long as you have excess capacity in your economy. But if you indefinitely try to monetize that debt, eventually you're going to have an inflation problem. So I don't think it's a viable long-term solution. I mean, right now, modern monetary theory is sort of having its day in the sun because people are pursuing very aggressive fiscal policy, and there doesn't seem to be any particularly adverse consequence. That's because there's plenty of slack in the economy, and inflation is not an issue. But I think that's really more of where we are in the business cycle rather than something that could actually be sustained on a more permanent basis.
So, final question on this topic. Of course, the inflation expectations are fairly low, even if you look at the 10-year break-even rate and so. Yep. But what's even more surprising is that the inflation risk, there's so much uncertainty about inflation. Do you see in the markets that the market prices in some higher inflation risk, or the products are not going out so much into the future?
I don't see much evidence that high inflation is priced into the market. I mean, you certainly don't see it in terms of looking at the spread between nominal treasuries and treasury inflation protected securities. That's where you would sort of see it priced in. If people were really concerned about higher inflation, I don't see it priced in at all in the market.
But that's about expected inflation. What's about not knowing whether it will be deflation, inflation, just the uncertainty?
Yeah, I mean, I don't have a good answer for that, Marcus. How much uncertainty there is right now, but I guess I would say that there's probably not that much uncertainty, because if there was a tremendous amount of uncertainty, I guess I would think there would be more of a demand for Treasury and inflation protected securities to essentially protect you against that particular risk, right? So if you really thought that your outlook for inflation were just highly uncertain, it could be 0 for 10 years, or it could be 10% for 10 years. And I would think you'd view Treasury inflation protected securities as a pretty valuable, asset to hold in your portfolio. And I just don't see that evidence by pricing today. So we can turn to the next slide. The last thing I want to talk about in some detail is the moral hazard problem. What we've seen in the pandemic crisis so far is that the Federal Reserve has intervened massively to essentially take away tail risk in a number of different areas. So the first big intervention we saw from the Fed was in the Treasury market, where the Fed all of a sudden decided that it was going to buy literally hundreds of billions of dollars of Treasury securities. And this was motivated mainly by the fact that there were a large number of hedge funds who were speculating in Treasury securities. They were invested in off-the-run cash Treasury securities. They were long that, and they were short Treasury futures, and they were picking up a few basis points in this trade. Now, a few basis points doesn't sound like much, but if you lever your position 60, 80, 100 to 1, you can actually then make real money. That was fine as long as the Treasury market was well behaved. But once the pandemic started to take hold, volatility in the Treasury market increased markedly, and the ability to hold these leveraged positions became very much impaired. And so these hedge funds had to start selling their cash treasuries, and this created a lot of dysfunction in the Treasury market. It started to actually affect Treasury market function. So rather than the Fed leaving these investors to their own devices, forced to sell the securities and take losses, the Fed basically came in and took the other side of the trade. They were essentially the buyer to these hedge funds as sellers, and that actually protected these hedge funds significantly. Another example where the Fed was taking away the tail risk is in terms of the corporate capital structure. If you look at the last 10 years, what you've seen is, one, a big increase in high yield debt issuance and leverage loans. And two, you've seen a migration down the investment grade corporate debt curve towards BBB. Corporations basically thought that in a low volatility environment, with long-lived economic expansion, little inflation, that it made sense to become more levered. Well, now we're seeing some of the consequences of that leverage with this sharp stop in economic activity. Again, rather than leave these corporations to their own devices, in other words, they pick that capital structure, so they're sort of taking the risk of being more levered. The Federal Reserve and the Treasury are intervening through a number of programs, a primary corporate bond purchase program and a secondary corporate bond program. And the third area where we see that the Federal Reserve has intervened to sort of protect people from their own bad behavior is the Fed has provided liquidity support for money market mutual funds, and they've been purchasing agency mortgage-backed securities to help support the agency mortgage-backed securities market. The mortgage REIT market is another example where firms had leverage positions in mortgage-backed securities, which were viable in a low volatility environment, but much less viable in a high volatility environment. Again, the Fed helped take those people out of that trade by buying mortgage-backed securities. Now, the problem here is that by the Fed intervening and taking away that tail risk, the Fed is likely to increase the incentives for people to take these kind of risks in the future. If you always know that when you get a tail event, that the Federal Reserve is going to intervene and bail you out, that gives you more incentive to take that risk in the future. So you can sort of imagine the story playing out time after time. Each cycle, you'll see more risk-taking, you'll see more moral hazard, and the Federal Reserve will be pushed into intervening to prevent that moral hazard, a problem of actually contributing to market dysfunction and a poor macro economy. So the question is, what can the Fed do about this? Turn to the next slide. Well, there's no easy way out of the cycle in the sense that there's this conflict between the short run and the long run. In the short run, you want to prevent the economy from blowing up. But if you do that repeatedly, prevent the economy from blowing up, you're actually increasing the risk of problems in the longer run. As we know, the political bias is towards the short run, and I think that's also the same for Fed chairs who have a 4-year term. Nobody wants to oversee a depression on their watch. So when push comes to shove, when you're actually in the heat of the moment of the crisis, the pressure is always going to be intervene to prevent the economic devastation that will hurt, not just the people who took on the risk in the first place, but also hurt a lot of innocent parties. So how do you break the cycle? Well, I think the way to break the cycle is you basically have to look around and determine who's actually systemic in the economy. In other words, if someone has to sell a lot of assets, if that is not systemic, then you don't actually have to intervene to support it. But if it's big enough to be systemic, then I think you actually do need to regulate it. The second thing is you might start to think about requiring entities that are highly leveraged to actually purchase liquidity insurance from the Fed. Make them buy insurance from the Fed so that they can offload these assets during times of stress, but make sure that they pay for it. Pay for the tail insurance ex ante, not in the middle of the crisis when it's probably too late. So if we turn to the next slide, please. So the other lessons, I think, in terms of how you deal with the moral hazard problems is that you fix problems during peacetime. Once you're in the middle of the crisis, it's too late to fix problems. We knew that money market mutual funds still had issues. We still knew that there was a problem that the money market funds had overnight liquidity, but they held assets that were longer term. So we probably need to do more on money market mutual fund reform than we did subsequent to the great financial crisis. Another area where you could definitely fix problems during peacetime is we have same-day liquidity for mutual funds that invest in highly illiquid assets like high-yield debt. Why do we allow that? If you invest in mutual funds that are investing in liquid assets, let's require them to have monthly liquidity, not weekly liquidity or daily liquidity, so that the investors know that they're not going to get their money back immediately. So people will be basically in those funds if they actually, can actually, don't need the money on a near-term basis. And also, if you obviously have monthly liquidity rather than daily or weekly liquidity, the risk of fire sales of assets would also be lessened. So, it's important to not assume that problems will just not be an issue. Let's identify the problems during peacetime and fix them so that when we get to the crunch time, we don't actually have to intervene in extraordinary ways. The final, I think, lesson of the financial crisis is that it's important, that confidence is very, very important in terms of how the Federal Reserve intervenes. The Federal Reserve's, as we've seen over the last few months, the Federal Reserve's backstop facilities were effective even before they became operational. In other words, people took a tremendous amount of comfort that the Federal Reserve was backstopping the corporate bond market and the municipal bond market even before they actually purchased any corporate bonds or municipal securities. But it's important to recognize that that's only going to work if the Fed has a program in which its facilities that it enacts have a track record of being effective. So one of the important implications here is don't throw a lot of spaghetti at the wall when you're in the middle of a financial crisis, hoping that some of the spaghetti will stick. Be very careful in terms of your diagnosis and design facilities that you are absolutely confident are actually going to work. Because if your hit ratio on your facilities is high, then the next crisis that arise, people will react to the announcement of the facility, get a beneficial effect before the facility actually is stood up. It takes a long time for the Fed to announce a new facility and stand it up. The Main Street lending facility is a good example of that. It's only starting this week, and it was announced back in March. So that gives you a long time. People were still wondering if it was going to work. That would be quite problematic for the Fed. And then the final lesson, if I can just conclude with one final thought, the Fed can backstop markets and the Fed can make monetary policy more accommodative. But the Fed can't influence the course of the pandemic, and the Fed can't restore income lost from the sharp shutdown in economic activity. And so I think there is a risk to the Fed here if the recovery turns out to be long and difficult, because people will be disappointed that the Fed isn't all powerful and can't make everything all right. Thank you.
Thanks a lot, Bill. So there's some questions about, so I would like to go through the slides again, essentially, and cover some more of these questions. One is about the Fed framework, and there was some hearing process going on. Let's restructure the Fed framework. Do you think with the COVID crisis, we will have a more radical restructuring of the Fed framework? And in particular, there are some questions coming. So far, it's very much interest rate focused, but not money focused. Will we come back and bring money supply and money aspects much more into the framework as well? So Eric Olson asked in particular, instead of the Taylor type rules, do we have in the future optimal policy rules which take the Fed assets to GDP ratio into account and duration of the optimal portfolio into account? Should this be part of a common rule or beyond just setting an interest rate where, it seems a secondary movement in interest rates these days? It's mostly on the quantity side. Can you elaborate on that a little bit?
Well, I've never been a fan of the Taylor rule for a number of reasons. Number one, it's not forward-looking. It just takes a snapshot of where unemployment and inflation are today. And so it doesn't even recognize that you're in a pandemic and the outlook is really dire. So the Taylor rule always causes you to react very slowly if you follow the rule when you're in the middle of sharp economic turning points. I think that, in the United States, I think money supply and reserves are probably not going to be a very good guide to monetary policy. My own personal opinion is that the Fed may continue to shift its focus towards financial conditions. In other words, how does the Fed's actions actually translate to financial conditions? Because it's financial conditions that at the end of the day actually provide the support to the economy. The Fed's rhetoric in terms of talking about financial conditions has shifted quite a lot over the last few decades. Fed talks about financial conditions much more. And so I think they'll talk about how their actions affect financial conditions, and financial conditions will be an important sort of intermediate target of monetary policy.
So can I just put some words into your mouth? So you expect quite a radical change in the framework going forward?
Well, I don't know that. I mean, I think that change in how the Fed thinks about things is already evolved. I mean, I don't think the Fed puts a lot of weight on the Taylor rule kind of formulations already. I mean, a good example, if you go back to, the September 2008, when the month that Lehman Brothers failed, and you looked at what the Taylor rule suggestion for the Fed was at the September FOMC meeting, depending on which Taylor rule you pick, Taylor 93 or Taylor 99, it was calling for the federal funds rate to be higher than it was then, in the order of 2.5 to 4%, that kind of range. So that just gives you an idea of how poorly the Taylor rule works at turning points. I think the Taylor rule is an interesting thing as a description of long-term historical monetary policy, but I don't think that it's forward-looking enough, and I also don't think it captures a number of the other important variables besides interest rates that affect financial conditions and therefore the economic outlook.
Very, very interesting. I think there's interesting research to be done. The next set of questions are more about the BOJ. What can we learn from the Bank of Japan? In particular, in context of the active yield curve control, if the Fed is buying so many treasuries anyway, is it like implicitly doing some active yield curve control? And, Japan tried to do some debt monetization. That's another question, and didn't lead to inflation. Why would you expect inflation in the United States?
Well, I mean, obviously, most macroeconomists have been surprised by the inflation performance in the U.S. over the last few years. If you ask people, we're going to get the U.S. economy down to 3.5% inflation and 3.5% unemployment, and there's not going to be any inflation consequence, people would have been quite surprised by that. So there is this question of where is the inflation? Now, it could be because full employment was at a lower level of unemployment than we thought, or that the Phillips curve is a lot flatter than we thought. It could be just delayed as opposed to, postponed indefinitely. But that's been a big surprise. I think in terms of Japan, in terms of yield curve control, I think the Fed's concern about yield curve control is not, putting it in, the entry into yield curve control. I think that's pretty easy. In fact, if you do yield curve control, you probably actually don't have to purchase as many treasuries because it's just the idea that you're going to be there to purchase the treasuries to keep rates from rising, make that asset less risky. And so encourage people to hold that longer dated asset. I think the Fed's problem with yield curve control is we have yet to see how it works on exit. And we haven't seen it work for exit for Japan either. And so I think people are concerned that, if you're actually successful and the yield curve control leads to a vibrant economic recovery, and then you want to let yields start to drift up, do you get stuck with a wall of money flowing your way in terms of 10-year treasuries, and does that then contribute to a very harsh upward adjustment in yields? I mean, could you avoid another sort of taper tantrum? Be sort of forced with a situation, either you buy a tremendous amount of securities or you let long-term interest rates go up sharply. Neither of those are particularly attractive option at that point. So I think the problem with yield curve control is really the exit. I think the Fed's going to be talking about it. I think they're definitely going to be talking about yield curve control, but I think they're talking about more as a adjunct to forward guidance. So I can imagine a situation where the Fed basically concludes, we're not raising short-term rates for several years because there's going to be so much slack in the economy, inflation is going to be so low, and we're highly confident about that. So we're going to basically tell the market that we're going to peg the current 2-year note yield at 25 basis points. And by committing to that 25 basis point peg for the current 2-year, we're basically just reinforcing our commitment that we're going to keep short-term rates low for an extended period. Now, I personally think today that wouldn't really actually be very powerful because the markets don't expect the Federal Reserve to raise interest rates in the next couple of years. So there's no disconnect between what the market thinks and what the Fed thinks is the likely path of policy. So I don't think that forward guidance really buys the Federal Reserve much right now because there's not really a big disagreement between where the Fed is and where the markets are.
Very good. But there's, of course, in the long-term treasury, and also in other markets, there were in March at least some problems on market liquidity, on market making, and the Fed stepped in as a market maker of last resort. Do you think that's on a temporary phenomena, or do you think it's something not of first order importance, or do you think that's a really important aspect in the future monetary framework as well?
Well, I mean, hopefully we'll avoid these kind of moral hazard interventions that we've had this time, because the Fed really doesn't want to do that. The Fed doesn't want to be forced to buy Treasury securities and agency mortgage-backed securities, because if it doesn't, it's going to have turmoil and market dysfunction in the Treasury and agency mortgage-backed securities market. And these are the deepest, most liquid markets in the world. They shouldn't be dysfunctional. So if they're dysfunctional, something went wrong. Something went badly wrong. Right now, the Fed's in the middle of a sort of transition in terms of their asset purchases. The initial asset purchases were driven primarily to encourage better market function in treasuries and agency mortgage-backed securities. And now they're transitioning to buying treasuries and mortgage-backed securities to make monetary policy more stimulative. The Fed hasn't really articulated very clearly yet where they are on that transition and how much are they going to dial down the Treasury and agency MBS purchases as we go forward. So that's something that may come out of this meeting that we have next week.
So the other thing people want to know, looking in Japan and other countries, is negative interest rates. Do you think in the US, the Fed is very averse to negative interest rates because of money market funds, financial stability considerations, or because it hurts the bank's profits margins? Or
I think there's a number. Yeah, I think there's a number of reasons why they don't like negative interest. I mean, as you say, if you went to negative interest rates, U.S. money markets would be severely disrupted, and so that's a cost. You have functional money markets, and all of a sudden you have dysfunctional money markets. So that's a one-time cost that you'd have to pay. Second, I think they do think it would put pressure on bank net interest margins and bank profits, and that would probably have some consequences for the availability and cost of credit. Third, I think at this point, they're really in a box. If you basically have been telling people how much you don't want to move to negative interest rates, if you were to finally change your mind and move to negative interest rates, it's hard to imagine that would reassure anybody. Yeah, whenever you announce,
what's your communication strategy if you were to want to do that?
Right. I mean, whenever you introduce a new policy that's supposed to be stimulative, you want it to be confidence enhancing. If the Fed announced, surprisingly, that they were going to move to negative interest rates after months and months and years of saying we don't like this, I think people would conclude, oh boy, things must be really bad. The Federal Reserve is really at the bottom of the toolkit here, as opposed to, I feel better because the Fed is moving to negative interest rates. And the last problem with negative interest rates, of course, is it just doesn't open up that much more room. You can only go negative to about maybe 75 basis points before people start to hoard cash. And so, unless you're in a world of digital money where negative interest rates can be, hundreds of basis points negative, it just doesn't introduce that much more room. I mean, I'm sort of where you are, Marcus, on negative interest rate. I think the short-term effect can be, somewhat positive in the sense of making financial conditions more accommodative, but the long-run effects then start to come into play, which is, in other words, the rate of return on savings is very diminished. Therefore, I need to save more to achieve my wealth objectives. And so the savings rate starts to go up. And so the long-term effects of negative interest rates, I think start to dwarf the positive consequences in the short term. So I'm not a fan. I'm glad the Fed is not a fan.
So let me conclude with the final question. Alan Center would like to know, do you think the Fed did a sufficient job in narrowing down the credit spread so far and bring the unemployment rate, or controlling the unemployment rate essentially? But I think they should do even more. And then I would like to get your sense, where do you see the size of the Fed's balance sheets in 5 years? Do you have a sense? Is there a rough estimate? Do you think it will go down or will go up, or just very rough to give us some idea where the journey is going?
Well, I mean, in the near term, it's going up. So I said 9 to 10 billion end of the year, and we'll see. That'll depend. Is there a second wave of the pandemic, and there's more economic disruption or not? If so, it keeps going up. There's no limit on how big the Fed's balance sheet can get, but obviously the bigger it is, the more longer duration assets they hold, the more interest rate risk the Fed is taking. But so I think it'll probably keep going up. And then there'll be a period where the balance sheet doesn't do much. After they start to, if we have a recovery and the unemployment rate gets down to 5 to 6%, the Federal Reserve will stop buying assets, and the balance sheet will start to go sideways for a while. And then if we finally actually get more inflation, the Federal Reserve can actually push inflation over 2%, then I would imagine the Fed would start to shrink their balance sheet again. But, it's going to be many, many years before we get back even to where we were, I think, before this pandemic. So I think we're, in a very enlarged balance sheet for a long, long time. Turning to the issue of credit spreads, I mean, I think at the end of the day, where the Fed wants the market to be in terms of credit spreads, are credit spreads consistent with the amount of credit losses that these companies actually are likely to create? I mean, they don't want the market to be so liquid that there's a big illiquidity risk premium on top of expected credit losses. they want people to be fairly compensated for the risk that they're actually taking, no more, no less. So I don't think the Federal Reserve would want to intervene in a way to push credit spreads, say in the high yield debt market, down to very low levels, because that would be distorting the market. It'd be basically making the value of the assets less than their expected value relative to treasuries. So I think that, the other thing I would say about the Fed's intervention in the high yield debt market, I think people are overstating how much the Fed is actually going to be able to do here. Just give you an example. I looked at all the high yield ETFs that the Fed can buy. It looks like the total universe of high yield ETFs are about 50-60 billion dollars. That's the universe of, and the Fed can only buy 20% of any ETF. So we're talking Fed's purchases of high yield debt through these purchases, maybe $10 billion or something on that order. That's trivial relative to the size of the high yield debt market. So it's nice that the Federal Reserve has reassured the high yield debt market that it's there. But the reality, if you actually look at the numbers and think about how big the Fed can be in that space, this is more, this is more at the margin rather than substantial.
You shouldn't talk too loudly about this, otherwise you might undermine the power of the Fed.
Well, I mean, if I could do the math, everyone else can do the math.
So let me ask you a final question. You mentioned earlier that the credit risk the Fed is taking on is fairly small compared to the interest rate risk. But for the credit risk, the Fed is taking a lot of precautions. It sets up the special purpose vehicles, Treasury jumps in with this junior tranche and so forth. But for the interest rate risk, there's nothing like that. And it could be that the Fed makes some losses and then has to be recapitalized essentially from the Treasury. So there's an implicit arrangement, but why are no special purpose vehicles for interest rate risk? Is this a strange thought? Why are treating these two risks so differently?
Well, the Fed could operate, the Fed could take losses and operate with negative capital. There's no reason why a central bank can't operate with negative capital. I mean, there's been a number of emerging market economies, central banks that have taken losses on their foreign currency intervention and actually have been operating for years with negative capital. So that's not a problem. The Fed has also got a contingency plan. If they were actually to have negative remittances to the Fed, they would probably put a deferred asset on their books that represents future seigniorage that the Fed would get from currency outstanding. And so that would be an asset that would essentially make the books balance. But this is, I just think it's worth, at least, when there are risks like this, I think at least it's worth acknowledging that these risks actually exist. Now, the reality is we got a strong economic recovery and short-term rates go up. The consequences of the Fed losing money are trivial relative to the benefits of having a much better economy. And that's how the Fed would explain it to people. But at the same time, we should recognize that there is a risk, that there is a maturity mismatch of significance in the Fed's portfolio. And we should just be aware of that going in.
But ultimately, what matters is the real rate, not the nominal one. Or if the economy recovers, real rate comes up, and everything, as you said, is improving. Of course, we have to pay higher nominal interest rates as well, but it's not such a big deal.
Yeah, a decent, sustainable economic recovery would be worth the Fed losing some money on interest rate risk.
Yes. The only danger is if we go in a stagflation environment.
That would be more problematic for the Fed, because then the Fed would be not generating the good outcome that it was hoping to generate.
If you were to look at the market signals to look for stagflation dangers, can you identify certain market products where you would say, oh, this would be the price to look at to get an idea that people think there's stagflation risk?
Well, I think the shape of stagnation risk, just look at the shape of the yield curve, right? If 30-year Treasury bond yields are below 1%, that market is basically saying we're not going to have a really viable recovery for a long time. It's going to be a long, long time before we get back to full employment. I think at the end of the day, in the last few years, people have been holding Treasuries mainly as a hedge against bad economic outcomes, rather than worrying about holding long-dated Treasuries and that being a risk of higher inflation. So I think watching the shape of the Treasury yield curve, especially looking out at the very long end, that's going to give you a sign of whether the risks are shifting from worries about the economic growth side to worries about inflation. And I would expect that we're not going to be worried about the inflation side for quite some time.
Great. Thanks a lot. Very insightful. Thanks. And I should say we are colleagues here at Princeton, so we can chat more over lunch once the economy opens up or the health crisis lets us to do so. looking forward to it again. And very much thank you. And I would like to do some advertising for Friday. If you would like to know the details, what went wrong in the repo market and how to fix it, and some proposal on the repo market, come on Friday, 12:30, with Daryl Duffy, who will outline his proposal on Friday. Thanks again, Bill, and hope to see you soon. And
Thank you.
talk to you soon. Bye-bye.
Thank you. Bye-bye.
Bye-bye.